Happy Halloween, everyone, and welcome to our Lenders Online training live stream conversation. I'm Dave Stauffacher, also known as Mr. Money, the senior credit trainer here at Lenders Online Training, where many of you know in the past that we're here helping lenders and credit professionals say yes to loans and no to the ones that may come out to haunt you. So joining me today are two of my favorite colleagues, Linda Keith, our founder, our chief credit training officer, and our certified playful accountant, is a true pioneer in credit analysis and lending education, many of you know. And our newest team member, Joe Davis, senior credit trainer with me. He brings a fresh perspective and a deep banking background and experience to our credit training team. So it's great to have both of you here today for our fun event. So today we're actually going to be stepping away from our usual Q&A, as you know, from the costumes that we may wear here. And we're trying to get into the spirit of the season with Halloween just around the corner. We're going to be sharing some real life lending stories, some horror moments with some innocent decisions in the banking world that kind of turned to credit nightmares. So tales of spooky, insightful, they're packed with some lessons. That's what we do at Lenders Online Training. So let's start things off. I want to talk a little bit about one of mine before I get into my colleagues. It's called collateral damage. It actually came from a tale in the vault that I had some experience with when I was a younger lender. And it was kind of where the borrower made some assets disappear, kind of like a magician, unfortunately. I'll give you a little bit of a backdrop. First of all, it was an established contractor in that type of sector, and it invested typically in fixed assets and to support operations. And it had some inventory that was there to fulfill their servicing operations as well. The banking relationship was relatively new. That's why they came to me. And the customer recently had switched some banks during the early years. So I was able to kind of track that early on. It was a typical relationship, a payroll, depository relationship, stuff like that. And I lent to him with some term debt and some revolving credit lines. Now, as time passed, there was a few overdrafts that started showing, deemed to be typical in that type of industry sector, at least from my perspective. We had a line of credit, but it was small, and I was renewing it basically on a regular basis. I would get financial statements and pass it on to my colleagues, and they put it in the file, right? That's what we're supposed to do, to say we have that. Well, kind of the event that stirred up was they came to me and asked for a title to be released on an asset without any conditions. Well, it was a title. We had a lien on it. So I basically kind of went to at that time, the director, and said, I would like to get a lien release. He at the time said, well, we need some money for that, and we need to apply it to the account. Well, not knowing what to do. And I said, well, okay. So I went to a site visit, went to see the client, only to find out that I wanted to explain my reasoning, but I found out with this wellness check that some of the items that I thought we had as collateral weren't there anymore. They actually had sold some equipment, and I didn't even know about it. I just knew this truck because it was titled, but some of the items that were non-titled were sold. So the monitoring of the portfolio asset, to my demise, I didn't do very well at it, and neither did my colleagues, because it was a small enough relationship. So I could have spent some time looking at the documents on annual renewals. So I could have been looking at statements of cash flows like we teach at Lenders Online Training. I probably could have found some red flags instead of realizing the biggest flag was my collateral was gone. Now, we needed to restructure. The relationship soured a little bit quickly, kind of at my demise. But in essence, what it was, the client eventually transitioned to a different bank. A relief for me, quite honestly, a learning experience for me as well. So I still, as I teach today, still gets me some chills about my nightmare that I experienced as a very young lender. So what we want to do now is turn to Linda Keith and kind of hear some tales that provide maybe some scariest things that she experienced. And the first one starts out with failure is an option. Linda.
Failure is an option. That's a big lesson. I'm going to start out though by saying that my hair always looks like this. I tried to make it scary for you. And really, this is just what it looks like. So failure is an option. I am not a lender. I have a CPA, public accounting background. I have trained bankers for over 30 years in lending. So I don't have my lending stories. I do have a couple of other stories that fit right in, though, with loans that go bad and disaster that maybe could have been averted. So this first one is actually about a bank failure. I was the shareholder of the 92nd bank to fail in 2009 during the Great Recession. And I'm going to tell you a few things that fueled that failure. But first, I want to say that if your first inclination is to think, that wouldn't happen at my bank, please change your thinking to how could that happen at my bank? Because I can promise you, even though I was not a director of this bank, nor was I employed by the bank, I knew people who were in both of those cases. No one planned to preside over the failure of their bank, and nobody does. So let's shift your thinking to a cautionary tale. 3 things that I will share with you that were significant in this. The first was September 2008, fully 1 year before the bank died. The Fannie and Freddie were taken over by the federal government, and in the process, they made the preferred stock useless. Well, Venture Bank, which was my bank, was not the only bank. There was like 400 or 500 banks, community banks, that held investments in Freddie and Fannie, and it was actually considered at the time by the regulators a perfectly fine investment to make. So this wasn't a mistake on the part of the bank, but it certainly hit them hard. They did a $40 million, I believe, loss on that one. So it hit their liquidity, and for the size of bank they were, that was a significant hit. At a time when it was hard to raise capital because we're in the middle of the Great Recession and all the banks are just stumbling. So that was number one. And that was actually the first one I was actually aware of as a shareholder and somebody just reading the newspapers. What I came to realize, both from talking with some of them, but also reading the material loss report that was issued by the FDIC, and even a report from the Federal Reserve about the impact of the Freddie Fannie preferred stock issues, I came to realize that there were some underlying things I just wasn't even aware of. And one of them may be an issue at your bank if you're in community or regional banking. And that is that they had developed a pretty significant concentration risk in commercial real estate, and particularly in acquisition, construction, and development. Well, isn't CRE kind of the sweet spot for a lot of community banks? So when do we transfer from sweet spot to concentration risk? And even though there was guidance at the time, it wasn't actually hard and fast. And if you were a little over, you could tell them how you were mitigating your risks. So I don't know as an insider whether they really knew that they were over the edge here, if they thought they were mitigating adequately. But clearly, when real estate as a product of their loans started taking a dive, their overextension in CRE was a problem. In addition to that, they were in growth mode. They'd gone from one building when I first became a customer of theirs to 30 years later, stretching from Seattle to Portland. They were purchasing banks. They were growing organically. And come to find out by reading the material loss report that some of that growth was fueled by brokered deposits. And later, towards the end, when they were scrambling, they were selling CDs kind of at high rates online. So they were doing unsustainable efforts to have enough money to withstand this storm. This was an entity, a company that really thought they were going to be fine. These folks never thought they would go down, and yet 3 strikes, plus probably some others that I don't know about, they were out. I was at a shareholder meeting, probably about only 5 months before the FDIC just, shut them down. And either they were totally delusional, which could be true, or they were trying to project confidence because they were telling us about a potential investor. They were going to San Francisco the next week. They already had a cease and desist, but they were fighting it and disagreeing with it. And they implied that they were going to be able to recover, and they did not. So what is the cautionary tale and how does it apply to you? Again, I'd just like you to think about, could this happen to us, or how could it happen to us? And rethink, if you're in senior credit, are there any things you've been planning to shore up that you have just been putting off? Are there things that you do know about that you could improve your risk picture? And recognizing that certainly we had the Great Recession, that was worse than many things before. And we had the Fannie Freddie, which they hadn't planned on. So those are why we have strong risk. One more comment before I leave you, and that is the comment of a chief credit officer that we interviewed for the credit risk readiness study in 2018. He told me that in the run up to the Great Recession, his board of directors was kind of irritated with him. Everybody else is growing like gangbusters and their bank wasn't growing as fast, and they really thought he should loosen the reins a little bit. He told me their story changed dramatically when they were able to go through the Great Recession without a big disaster when these others were failing. So hold the line on your credit culture, understand what your risks are, and don't put off those steps that you probably know you should be taking to be ready for whatever's coming, because something's coming.
Linda, you covered a lot of, I was going to say, Linda, you covered a lot of ground there, but one of the things that I would point out is we look historically, we're due for recession every 7 years on average, right? We haven't really had one for 15 or 16 years. So we're overdue for two. So it's not a matter of if, it's a matter of when. And people that are perhaps newer in their careers have not been through a down cycle other than a blip we had during COVID, right? Which was fairly short-lived, all things considered. So it's why we preach fundamentals. It's why we preach, holding the reins and really sticking to your loan policies, because it's going to show up. It's going to happen at some point for sure.
Well, and those people that are newer, their job is to really understand the guidance from their leadership on concentration risk, on what are we looking for. And speaking of concentration risk, I know that we're setting up this CRE course, and we're going to be talking about many of the specifics that are coming up in these horror stories.
Definitely.
So, Linda, failure is an option.
Sadly,
it's a haunting reminder that there is a difference between greed and growth. And it's not always easy to spot, even when you were involved inside that bank and knowing some things.
Yeah, that's right.
So if you like that story, Linda's not done. Her next tale is a mystery about miscommunication, misaligned expectations. So let's hear that nobody knows what's going on with this loan.
So the interesting thing about this is, again, I'm not a lender, but in this case, I was the borrower. So I'm going to tell you about a situation where I was borrowing on a loan that almost went down because of communication rather than any fundamentals. So I was the CFO of my husband's construction company, and this was a line of credit that we regularly use. Many years we didn't use it at all, but we had it ready to roll, and we would use it for short-term needs. One year we had a big project we were going to do, and I knew that we wouldn't be able to retire that line of credit quite on time. So I sat down with the banker. We ran through what our plans were. He looked at all that and he says, this looks fine to me, Linda. And with your experience with the bank, longtime customer, and what you're doing, I don't see any problem. We'll be able to roll that for you for that couple months you'll need. I said, great. Off I go. It comes time for that due date that we are going to presumably roll. And I get a notice from the bank saying, I think it was $70,000 is due. And I kind of said to myself, I don't have $70,000. So I called the banker. He wasn't there anymore. He had gone somewhere else. I don't know where he was next, but he wasn't even with the bank. And I was talking to someone who had stepped in and replaced him. And I explained what was going on. And he's looking at that file and he said, Linda, there's nothing in the file about this extension. But he says, not a problem. We'll just automatically extend it for 30 days. Let's get you in here. Let's work through what the plan is, and we'll figure it out. I said, great. I'm going to be traveling for 2 weeks, so I can come in 2 weeks. 2 weeks, I get back from my traveling. I go in to see this banker, and he's now gone because he was kind of just stepping in to kind of clean up some stuff, I think. Maybe he knew he was cleaning up stuff, which is why he was so happy to just say, extend it for 30 days. We'll figure it out. Maybe he was doing that a lot. I don't know. So now the new person said, oh, well, we need to have you come in, etc. And I made plans with him, but then I made a phone call to the senior manager of business lending, who had been my business banker, years before. He's moved up. And this is, by the way, a cautionary tale for you. Make sure your borrowers have relationships with multiple people in the bank. So if you are not available at some point, there is somebody they can talk to where they feel like, okay, somebody knows what I'm doing and I'm okay. So I called John up. I says, John, I don't think anybody in the bank knows what's going on with this loan. Little pause. And then he said, well, Linda, and nobody's worried about it either. He says, okay, good to know. But John, I want to be sure I don't land on your bad list. So whatever you need to do to keep me off the bad list, I definitely want to tell you what my plan is. We need to be in agreement here, but I don't want to hit some list I don't want to be on. He says, not a problem. He calls me back 3 days later. He says, Linda, you know that list you don't want to be on? And I says, yes. And he says, if I don't get a signature before tomorrow, you will be on the list because unfortunately, the person that was supposed to do the 30-day extension for you did not do the paperwork. Now, I now know he didn't want me on the list because it's a problem for him when that list gets bigger, right? At the time, I just thought he was taking care of me, the borrower. But I said to him, I said, John, problem is I'm home with the flu. I am sick. I cannot come in and sign anything. And he said, Linda, could you get dressed? And I says, yes, I could get dressed. He says, great. What time can I come over? I'll bring the paperwork. So he did. He brought the paperwork. We got it signed. Everything worked out. But here's a couple things about this story. There was nothing wrong with the borrower. There was actually nothing wrong with the loan. The problem in the first place was that first lender did not document the conversations, the plan. Possibly he should have written the loan differently at that point. That I don't know about that, but I just know that when I touched base again, nobody knew what was going on. That was not a confidence builder for me, by the way. But long-term relationship with the bank pays off when people can accept a mistake you've made, accept your apology, have you work it out, and not go tell all their friends what a lousy bank you run. So documentation was the first problem. Second thing obviously happened when they didn't do the paperwork for the extension. They never said this to me. I just think something went wrong with the first person. The second person came in and tried to clean it up and things kind of fell through the cracks is my guess. I actually don't know. But they apologized. They took care of it. John came out to the house. I got the signature done, and we continue to have a long-term relationship with this bank. So loans can go bad, not because there's anything wrong with a loan, but because something happens at your end. When it does, apologize, fix it. And of course, internally, I hope they went back and said, okay, how the heck did that happen? And how can we make sure it doesn't happen going forward? Have you ever heard of anything like that, Joe, David?
Oh, my miscommunication often happens in even the relationships that I work with now of trying to get clients to work with their bankers to get things to document. And I know when you often hear me in our classes, we talk about documentation and the necessity of just keeping some notes down so that whether you can recall something that you kind of had talked about 6 months ago, or if you do move on for whatever reason, your colleagues can pick it up. And quite honestly, with your situation, it is hauntingly familiar in the sense of somehow nothing else was wrong with the loan. It was just administrative behind the scenes. And fortunately, these lists that we talk about, Joe, you know the lists, they are embarrassing to all. If I'm a banker, I don't want that list to grow. But as you as a customer, honestly, I don't know what this list is, but it doesn't sound good. You don't want to be it on as well. So I agree with that.
Yeah.
Well, and one of the things that we talk about, I'm sorry, Joe. One of the things we talk about in the class is the documentation, but also the recognition that when you're trying to maintain a positive relationship with borrowers going forward, and you might be new to the relationship, being able to look in the file and see what the last conversation was so that you're asking an updating question instead of saying, so Linda, tell me about what you do. It is hugely helpful for the bank to maintain those relationships by not making these people start over because they're new to the borrower.
That is
Yeah.
awesome. And that's a combination of not only the newer lender that's coming in to being a little bit proactive, but feel confident to talk to your peers, talk to your mentors, and ask them to follow along and just kind of understand what's going on. Because behind the scenes, your relationship to us, and we don't want you to feel slighted in the sense I'm asking you the same questions that oftentimes when we're online calling someone out, they're asking the same questions. They move us to a different department. They ask us the same questions that I just answered to the first person. And it's quite frustrating for me, especially if I've been a borrower for 10, 15 years. You should have all that information, right?
Yeah. Absolutely. You said a couple things that ring true to me, Linda. One is that a lot of bankers are nomadic, right? Unfortunately, for whatever reason, people move around, and that's just, it's inherent in the industry and in many other industries. So David's heard me say this ad nauseum. You have to paper the file. You have to put your notes in the file. It does a couple of things. One, if Joe gets hit by a bus, we don't lose everything, right? Number two, your regulators want to see that. They want to see that you're talking to your customer. They want to see that you're on top of the relationship. They want to be able to crack open the file and have a really good handle on what's going on. So a little bit of time just spent throwing a memo to the file or some notes in your CRM platform, it goes a long way.
Awesome. Thanks, Joe. Well, now that we had Joe talk a little bit, let's hear a couple of spine-tingling stories that he might ask us kind of on how basic assumptions can lead us off into a dark place. So, Joe, why don't you kick us off with, wait, trucking companies actually need trucks? What a title.
Oh, yeah, man, this one still gives me the willies, I tell you. And, if you do this long enough, if you do this for almost 30 years like I did, you have some loans go bad, right? So this one is one that I think about from time to time. It's just got a lot of fundamentals in it, a lot of good examples of things not to do. But this was an acquisition of an over-the-road trucking company. Okay, they had a fleet of about 20 trucks. They had several long-term employees as well, several long-term drivers, which is really key. Everything looked good during underwriting, right? We ran the standard cash flows. We were going to have a decent amount of collateral. Our borrower, the buyer, had good credit and some assets. So everything looked pretty good, but a couple red flags. One, the buyer was new to the company. He wasn't a family member. He wasn't a long-term employee. He was essentially somebody off of the street looking to buy a company. Also, the buyer and the bank didn't do adequate research on the condition of the trucks to be acquired. Okay, they hadn't been acceptably maintained. The seller wasn't replacing the fleet, wasn't having the annual capex that you would need in order to keep those trucks fresh. On a reasonable schedule, but also the repairs and maintenance were done inexpensively rather than properly. And he was doing this for a few reasons. This was in part or in mostly to inflate the profitability of the company. And he was doing that in order to make it more valuable. Most companies are valued based on a multiple of EBITDA. So if you get that profit up there, your company's worth more in theory. But he was doing that by cutting out certain expenses that he shouldn't have. So you can see where this is going, right? Fast forward to after the acquisition that my bank financed, and of course, the trucks are starting to have maintenance issues. They were breaking down and requiring considerable repair work. Took them out of service, which decreased the revenues and it increased operating expenses. Okay, so we're squeezing profitability. It also caused a lot of frustration for the employees. Those drivers, hey, if I'm not on the road, I'm not earning any money. So the company lost a couple of those long-term drivers who proved really, really difficult to replace. So ultimately what happened here is they had to downsize operations for a few years and really get their legs back under them. They had to replenish the fleet, they had to stabilize the employees. So, and also, on the bank side of things, we had watch credit on our hands for a few years while they were getting everything figured out. So I learned a few lessons on this deal. The bank did more research with a site visit, in particular to gauge the condition of the collateral. Also, it's possible to have a third party go out there, someone that really knows trucks and can tell you what they're worth. You get an equipment appraisal. So that's a good thing to do. Also, we should have dug deeper into the financial statements to see the levels of capital expenditures and to see the repairs and maintenance expense, especially the trends in those numbers over time. So not just the recent periods, but also what they looked like historically to see that they were reducing those things in the years leading up to the acquisition. So when underlying training covers financial statement analysis, trend analysis, and red flags, all those were topics that would have helped me conduct better due diligence and properly underwrite this loan. Probably wouldn't have done it. Here having hindsight 2020.
Joe, that's awesome. And actually kind of reminds me that it's probably important for all of us to check our collateral schedules, like I should have when I was a young banker and missed out on that opportunity. But we do teach that at Lenders Online Training. We talk about that. The red flags, that's something that you just want to be aware of it. Is it something that we need to be concerned of? Maybe. Something to be aware of specifically, especially when you're dealing with heavy equipment type industries. We talk about when the trucks are in the shop, the old adage, when the wheels aren't rolling, we're not making money. So those are things that we point out. And these are signs that maybe we can help the relationship, not necessarily look at it from a negative perspective, but just understand what's going on and where the trends are. Joe, that was an awesome story, but I think you got another tale, don't you? Something that brings the ghosts of poor underwriting up to roam the halls. Haunted office buildings. You got some interesting titles here, young man.
Yeah. Let me go from bad to worse. So this is a multi-story, multi-tenant office building in a secondary metro area. So even before the COVID pandemic, the building was really struggling. And what caused that was a major tenant vacated. It's a 5-story building. The tenant on the first floor and also that part of the basement gone. Left. So a real strain on cash flow because those rents weren't coming in anymore. So as a result of that, the owner was not spending adequate funds on repairs and maintenance or on the bigger ticket items like the HVAC system, so the heating, ventilation, AC system. Those don't last forever. You have to keep them up and you have to be replaced every, call it 20 years. But the disrepair that resulted from this cash flow squeeze really started impacting the remaining tenants and certainly drove away any tenants. Nobody wanted to be in this building. So then fast forward and the pandemic hits, a couple of years after this. We all know we have office space during and after that time. So now the building is really struggling. It goes from just a sort of ordinary watch credit to something we're really, really concerned about. The owner did not have adequate outside funds to inject the needed repairs or the day-to-day cash flows. So he began paying his suppliers, the management company, the contractors very, very slowly. Then, to make it worse, the bank discovered that the property taxes hadn't been paid. Okay, this is a really big deal. As we all know, property taxes, when delinquent, can slide in front of your mortgage. So even if you have a primary mortgage, property taxes aren't paid, government slides in there and sell the building, foreclose on the building, sell the building if they need to. So the bank had a decision to make. Okay, should it loan more money and pay the taxes to make the needed repairs? That's one option. Should it declare a default and start the foreclosure process? There's another option. We did not have a personal guarantee to go after. So these options are really lose-lose. In either scenario, the bank was going to lose money. We knew that. The story really demonstrates the point that bad things happen. We have to prepare for the worst. Okay. At one point, this was the preeminent building in the market. It was fully occupied. It was generating strong cash flows. The employees were there. They were happy. So banks need to think about what can go wrong. So what Linda was talking about in her example, you need to think about what can go wrong and what steps you can take to protect yourself. So things like personal guarantees, things like an acceptable loan to value with periodic revaluations. Don't just get one appraisal at origination and leave it on the shelf. You have to do that periodically. Maybe a cash flow. We could have caught some issues earlier, getting back to the table. I would have liked to have a reserve account in place. So in other words, they fund a reserve account over time, and that would really help us. So I bring up this example in light of Lenders Online Training's new commercial real estate course, which we're targeting to release in early 2026. We'll definitely cover the fundamentals. We'll cover some more advanced topics and things that really prevent issues like the one I'm talking about from recurring.
Joe, that's awesome. I mean, definitely some spooky scenarios with there. I think I'll close out our storytelling session right now with one more tale. One more tale from the lending crypt. I kind of like these Halloween twins. Sorry, that's just me. This is about a startup winery that had all the right equipment, but didn't have any of the cash. So how about this title? Grape to Grave. A startup that couldn't breathe. Kind of cute there. That's me. A little bit of a backdrop. Okay, this is a new startup situation that I became aware of. So it has some agricultural flair to it, some beverage making, and it actually had hospitality connected to it, to events and spaces there. So it needed investments into fixed assets, real estate, equipment, all those shiny things, right? But it also needed things such as inventory. I need to fill the shelves. I need to fill the tanks. I need to do something of that because that's how I service the marketplace. That's how I make money. So typical relationship, it was new. So the bank involved with this was relatively new. They were interested in it because of where it was located, as I understood it. So they did their typical kind of nominal lending aspect as they first started with land, right? You needed land to grow the grapes. Pretty easy decision, at least from the banking perspective, because there was a lot of investing in land, money into the deal. So there was equity. So let's lend on the equity. Why not? Okay. So then you're going to use the land to plant the crops. Okay. So that's something. But now we need a building. We need a building. We need all these shiny tanks because that's what we do. So that was kind of easy to understand. More shiny things that they wanted to do. Well, the problem as time went on, the agricultural process takes time. Grapes, for many of you, takes probably 3 to 4 years till they actually can produce something to do something with it, to create the wine. So some of the discussions now to focus where the discussions were lacking insight could have been understanding of the business sector in itself, allowing in this case to know, all right, it's going to be taking some time from an agricultural perspective, but that's one sector. This is a manufacturing operation. That's another sector. How do we blend them both together? Because now we're getting into the thought process of inputs in, product, wines, whatever. How do we actually make money? We need inventory, not only some raw stock that we can do something with it, something that eventually will happen 3, 4, 5 years down the road, but how do we make money to at least pay our banks back? So sometimes it was a disconnect between two sectors. What industry were you in? Can you blend both those instead of just looking at the shiny equipment, looking at what we had for collateral, and how do we understand how a business makes money, what their sources are, what their uses are, what is their operating cycle in general as a lender? So I don't place any blame on anything, but it's a reality when we're dealing with many businesses, and we talk about this at Lenders Online Training, is what sector are we in? How does it interconnect? What is their revenue model? Now, we can under some of it from tax returns as the business goes by, but what if it's a new business? We talk about a business plan. We talk about projections, but what's involved in that? We're forecasting something to happen. But what this happening is, how does it impact how I make payments? Because remember, at the end of the day, we bankers want to make sure we get paid and understanding where it is. The other thing to be aware of is the whole stress of the situation. The clients knew what they wanted to do. They wanted to grow these grapes. They wanted to sell them. They had a perfect plan of what they wanted to do. The challenge is we put them in a bad spot, right? We didn't give them enough leeway. Now, we forced them all this time to feel uncomfortable, to feel stressed where things were coming from. But I think we could have slowed down the whole process of understanding the whole picture as to how this business operates, what cash is needed, what terms we may need to conditionally stretch out a little bit, though it makes best sense for everybody. Now, fast forward, the relationship is going fine. The grapes are coming in fine, but it started out for the first early years, probably a little bit misguided. Stress for all from the bankers. They were stressed because the client would have been on the list, right? The other thing is the client was stressed because where am I going to come up to make my payments? I wanted this relationship. So truth be told, it's trying to understand everything's involved, from numbers to what do they mean? What happens between those numbers? We talk about that. I spent a lot of time with our financial statement analysis course. We offer that at Lenders Online Training. So we talk about sources and uses. What's happening? What do we think is going to be happening with cash flows? Kind of more than just looking at a balance sheet and income statement, but what do those numbers really mean? So we talk a little bit about that. That's our final tale. Kind of our journey through the haunted halls of lending comes to an end, right? So before I blow out the candles and close the crypt on this little holiday fun event, I want you all to know that our mission at Lenders Online Training focuses on lending and credit professionals. Many of you that are listening, we want you to say yes to good loans with confidence, clarity, maybe a bit of courage, but we also want you to be aware of the lessons that we talked about, because we don't want any haunting stories. You don't want any haunting stories. So what I often say is, check us out. Check out our lending activities, our training activities. Drive into what our on-demand resources. Give us a call at lendersonlinetraining.com. Talk to us. If you want to have just a little snippets of things that go on, our experts at Lenders Online Training, filled with questions and answers from many of you, and we try to give our percent from my perspective, Linda's perspective, Joe's perspective. The other thing I want to touch on before we close is what we're exciting to talk about is our commercial real estate class that we're developing right now. We're asking you for some input. We're excited about this because everyone's portfolio focuses on real estate. There's always some sector on real estate, whether it's individually owned and it's part of my business, or whether it's investment. We're going to talk about the fundamentals, and we would love to be able to share that as well, and love to be able to have your insight. You'll see a code up there. Check on that. It's a survey asking you to say, what's on your mind with regards to commercial real estate? Anyone else? Joe, Linda, any final thoughts?
I just think you came up with 2 new C's of credit.
Gosh.
Courage and clarity. Let's add that to the rest of them, because those are good ones. Joe, how about you?
Yeah, love it, David. That's really good. And I'm going to get a shirt that says "paper the file," like you say. But no, these stories are not meant to scare anybody away from lending. We're in the risk industry. We take risk. We take calculated risk. The important thing is to understand the risk so that you can mitigate it, but then also get paid for it as well with your interest rate. So that's really why we're demonstrating these stories.
So in final, don't let your next loan be a ghost story. Check out our Lenders Online Training. From all of us, Linda, Joe, myself, thanks for joining you today. Being kind of a walk along with our humor on Happy Halloween. So I wish you the best and a safe Halloween. Take care, everybody.
Trick or treat.
Happy Halloween.